Hey guys, welcome back to We Talk Money. I'm your host, Chris Dunn, joined by Travis DeVitt, Stock Investor Pro, and Nikki, who's a certified financial planner. And, we've had a lot of questions come in about the markets because stocks obviously in the spring sold off really hard and then had a big bounce and a recovery. And, right now, a lot of people are just trying to figure out what to do. So the first question that we got is from James, where he said, would it be wise to move a portion or all of your stock portfolio into cash, anticipating a second wave of COVID-19 and an economy shutdown, right? And right now in the U.S., we actually have numbers that are trending up again, new cases, and they're at the highest levels since early May. And specifically here in states like Texas and California and Florida, there's some hot spots that are growing. And, again, we had stocks that sold off really hard back in the springtime and then had an equally aggressive bounce. And so I'm not surprised to see a lot of questions coming in about this. What do you guys make of it? Do you think now is a good time to go into cash? Do you see reasons to hedge? What are you guys thinking and doing? And I feel like this would just be a good kind of place to start, and we can lead into some of the different things that are actually happening in the markets right now.
Yeah, definitely. Yeah, I think that's the big question on everyone's mind is, okay, what next? What comes next? And this is actually one of the most uncertain market environments I've been in a long while. And, I had a pretty clear view of what to do in March and April. But at this point, it's very, very unclear to me what the path forward looks like. So personally, myself, I have added to cash. Like I've sold some of my winners and added cash to the portfolio, and I've added some hedges as well. Because I'm okay to just kind of sit out when I don't know what's going on. I'm okay to just sit out for a couple weeks or a couple months and reassess the situation. And obviously, I'm still looking for single stock ideas and new ideas and things like that. But I do think there's a lot of questions up in the air, like you mentioned with the virus numbers, the economy. We still are seeing an increase in recovery in different parts of the economy. But on the flip side, we're seeing the potential for increased risk and the increased shutdowns. And so I don't think anyone really knows. And with the valuations much, much higher than they were a couple months ago, the risk reward picture shifted. And so that to me is really the biggest part of the equation is, yes, things could continue to improve, but for me, the risk reward just isn't quite there. And so that's kind of how I'm looking at it and constantly reassessing. But will we have more shutdowns? That I'm not so sure about, but I do think we'll see an increase in restrictions again. I know the Texas governor is speaking today. They've been cracking down on bars that haven't been very good about keeping their numbers at reasonable levels and things like that. So I think we'll see an increase in restrictions. Hopefully some of the younger cohorts will start taking things more seriously, because I know a big part of the numbers increases have been with the younger cohorts. So yeah, we'll see.
Yeah, specifically in our county, in Travis County, you can see just over the weekend, we added just shy of 1,000 new confirmed cases. And I don't think that's a coincidence that happened just a couple weeks after the Memorial Day holiday, where a lot of people kind of forgot that COVID existed. And then, the protesters really kicked in. And so we're starting to see some parabolic numbers, which is really helping drive Texas to these highs. So what are you guys thinking, like, over the next few weeks and months? How is the market going to respond to this?
I actually wanted to add something to the conversation about going into cash, if you guys don't mind.
Yeah, please.
So before we move on to the next topic, I wanted to kind of add that this is a delicate dance here, because as you guys know, I like looking at the charts and the price action and kind of reading into what's happening there. And I look at the chart and I'm seeing bullishness when I read this price action in the S&P and the NASDAQ. And I think that it's tricky because sure, you could, go into some cash up here in anticipation of a rollover. But the other thing that I'm thinking about is I've seen some data come out about there being a lot of cash on the sidelines, ready to deploy, which, when I look at that price action, of what you have up there, the NASDAQ. And I'm thinking there's a lot of people that have cash on the sidelines already. If there's this challenge between you, if you go to cash, the market could just keep flying higher, even though it's completely disconnected from what we're seeing in the reality of what's going on with the pandemic. And it could run off without you as well. So, like Travis said, it's definitely a tricky time. But I know that I have some cash on the sidelines, and I know other guys and gals in our community do too. So it's tricky when I look at that price action.
That's a great point. And I think we always talk about how it doesn't have to be black or white, and you can have different capital buckets. You can have your longer term capital buckets that you just don't even touch. I don't think anyone really should be making a call to be all in or all out of all of their investments, especially if you have a long-term horizon. And so I just want to make that clear too, when I talk about, kind of my positioning. A lot of what I'm doing is around the edges, the stuff that I think either hit my price targets or, got to levels of valuation that I think is unsustainable. I may sell down some of those positions, but I still have quite a few core positions that I'm holding for multi-year timeframes and things like that. Yeah. So, I've got, when I move from, 70% net long to 50% net long, obviously I still have exposure to the market and to certain stocks. So
yeah, it's like a lever, right? It's not like an on-off switch. It's a lever of how invested you want to be. And I think that's a good tangent into, this was what Fidelity came out with a survey where they looked at a percentage of individual investors who sold, did they sell everything?
They sold all of their equity holdings, according to this.
Wow. So basically so in the age brackets of basically 60 and above, you had 25 to 30% of individual investors who sold everything during the market crash in the spring.
And granted, we don't know, usually when you get into the later years, into retirement years, you don't have as heavy of an equity allocation. So they're not really touching on that part. It's probably not making or breaking them if they were properly allocated. However, if they weren't and they did have a large equity holding, that sucks, because that was probably, as we know, the worst time to be selling, and it was likely triggered by emotions and panic. Yeah. So it's just unfortunate when you see how strong the recovery ended up being.
Yeah, there's a interesting article from 538 that talks about, the economy being a mess and a lot of the indicators looking really bearish, but, the stock market basically being disjointed from that. And we've talked a lot about this over the past few weeks, talking about how you really don't want to fight the Fed. And in the short term, they're taking as much action as they can. And there's still a lot of numbers that look really nasty, but, there's a lot of confusion as to why stocks are at all-time highs when you've got stuff like this. 30% of Americans missed their housing payments in June. So I don't know. It is a very strange time in the markets. And even looking at Bitcoin, Bitcoin has actually been holding up really nice through this as well. I think the longer that we coil up and really squeeze up into 10K, the better. We've also got gold that's holding up really well. So it just seems like markets in general, granted all the fear and uncertainty and stuff that feels like it's out there, there's just not a lot of panic selling happening right now. Things are just kind of trucking forward.
Yeah. We've seen some businesses that have obviously benefited from this environment and a shift towards certain things, like a shift to e-commerce and even domestic travel and things like Airbnb, which were down 80-90% in March, are now up year over year. I believe some numbers I saw for June or a month to date showed that Airbnb's bookings were up 20% year over year in June. And that's obviously because a lot of people can't travel internationally. So there's a lot of shifting happening to certain businesses and certain categories. We've seen used car prices recover pretty fast. Those traveler numbers that you're showing that we compile still improving. The rate of improvement has been slowing down a little bit, but those numbers keep rising. So there is some reason to be optimistic, especially in certain areas. Software businesses still growing very, very rapidly. So that's one driver of tech. And so we see things like that. Also, rumor of another $1 trillion fiscal stimulus package being prepared by the Trump administration. So we'll see what comes of that. But that could also extend some of the unemployment benefits. Maybe there's infrastructure spending in that, things like that. So it's a really strange economy. Like I said, that's one of the reasons why I think there's just so much uncertainty. I think some people are getting over their skis a little bit with how they're projecting forward some of these shifts, because, if you think about sporting goods stores, for instance, yeah, they're seeing a really big uptick in demand right now, but what happens in 6 months or 12 months? What does that look like if we're still at 10 or 15% unemployment? So
Yeah.
that's the hard part about thinking through all this and trying to figure out where to go with your investing allocations right now.
Yeah, good point. I mean, when you've got stuff like Zoom that's up from, $60 to over 250, you've got Square hitting new all-time highs, Facebook up around all-time highs, Netflix new all-time highs this week. It's a very, very interesting bifurcation in the markets, right? A lot of stuff that got hammered had a little bit of a bounce, but travel is still down. Yeah, just very weird time in the markets.
Yep. I was fist pumping because you named a couple of the stocks that we bought in March.
You guys have had some really big gainers over the past month or two. It's been really impressive.
Yeah, it's been a wild ride.
It's been fun.
Awesome. Let's see. Next question's from Tim. He asked, for early Bitcoin adopters like you and Rocky, you have a lot of experience. I sense that it allows you guys to trade and buy with a lot more freedom and confidence. If you bought in as I did and currently have a Bitcoin cost basis of 8K as a long-term hold, but would like to increase your holdings with minimum further capital injection, how do you start to do this in a small way without undue risk? I'm guessing the safest way is to scale in on capitulation. So again, the first thing I got to say, I can't give personalized financial advice, but to answer this for anybody, because this is a question that we get a lot, is like, look, Bitcoin is relatively expensive in, quotes, relative to where it was in recent history after the crash to 4K. Just in general, the way that I like to answer this is anybody that is looking to increase their Bitcoin holdings, you want to buy an amount that if it went down by 90% tomorrow, you would not be hurt and you wouldn't capitulate and sell the low. I think it does make sense to have capital on the sidelines waiting for washouts and breakouts. Those are typically the inflection points that I like to get in on Bitcoin, is when there's either a breakout of a key level, like 10K, for example, or when you get a big washout. Those inflection points in the market just tend to be good entry zones, where if you're buying after, say, price went from 4K up to 14K like last year and you're chasing the highs, you are 10 times more likely to panic sell the lows because your cost basis is higher, right? So again, I'm a firm believer that I think everybody should own some Bitcoin. What that is, you have to decide on how much you want to allocate to it. But just do it in a way that if price went down by 90% tomorrow, you wouldn't join the masses in being a panic seller, right? So just like the stock market is kind of overvalued in a way, and a lot of things are just overheated. I also think that, Bitcoin is at a point where it's been flat basically, since June of last year. We're literally at the same price as June of 2019. And so I think that's good that price is holding up, but you also need to look at the volatility and know that it has really, really big range, and you just don't want to be caught up in that emotional money. So hope that's helpful. Any other things that you guys want to add to that? Any other opinions about crypto or Bitcoin or how to scale into long-term positions like that?
Yeah.
I think, go ahead, Trev.
No, I think that pretty much touches on it. Like I always, especially for something that you plan to hold long term, being able to average into it over time, little by little, I think is a interesting strategy. That way you don't have to nail a perfect, local bottom or local top with your buys and sells. You can build your position over time. And yeah, your average cost basis isn't going to be as low as if you made the perfect buy trade, but that's okay. Like most people, most of us, even good investors with good track records, aren't going to perfectly nail tops and bottoms. And so we're trying to get a good solid return for our portfolio without taking a bunch of risk, without trying to magically pick a bottom. And so,
Yeah.
yeah, that would just be my suggestion is.
Yep. Took the words out of my mouth. I was going to say something similar.
Yeah. I mean, I think that's a good segue into this recent sad story and kind of what we're seeing in the markets right now with, we've got this combination of, a lot of people in quarantine, a lot of young guys and ladies at home that have never really traded the markets before that are getting on Robinhood. And then you've got sports that are really non-existent right now. So you've got a lot of gamblers that are looking for action and where else is more exciting than in the stock market and the crypto markets. And then you've got, guys like Portnoy, for better or worse, he's pulling a lot of eyeballs into the market, but he's doing it with that kind of gambler mentality. And then you've got Wall Street Bets on Reddit, who is also kind of adding fuel to this fire. And unfortunately, last week, there was a 20-year-old kid that killed himself because as he was trading options, Robinhood showed a negative $730,000 balance in his account, which actually wasn't even really the case. It was the way that the options was settling. But he killed himself because he thought he ruined his life. And I thought it would be good to kind of speak to, I guess, just the general theme of this weird culmination of all these different factors and how it's pulling new people into the markets, which is a good thing. But is it necessarily a good thing that Robinhood's making it so easy to get into options trading and, use margin or leverage or just get into these really big position sizes that people might not really understand what they're doing?
Yeah, this story crushed me last week. The reason that we do what we do is so that we can help people avoid things like this. Like we are focused on investor education and we have our investing community and we have our investing courses. And the reason that we do it is because this investing is hard and it's complex and there are lots of topics within the broader topic. And it takes years to really even master one particular area of it. And I think it's great that more people are getting involved with investing at a young age, but I also think that a lot of people need to really think about, educating themselves and think about like focusing on more learning before they go and aggressively get into things that are very, very high speculative plays. I mean, in this case, it's just like a really, really unfortunate situation because like you said, like he was in a position, I believe it was a bull call spread or a bear call spread, which is an options position where you actually do have a limited loss cap, but one of the legs of the option got exercised and his account showed that he had a massive liability, but he had an offsetting hedge there. It's just that the Robinhood UI didn't properly calculate it or properly show it.
Yeah.
And, I've had things like that happen to me and luckily, I know what I'm doing and I've had years and years of experience with both like stocks, futures and options and things like that. But having someone that you can talk to, like in our investing community that is an expert, I think can be really helpful when these types of situations happen. Because, panicking is not what you want to do. Like, and certainly taking your life is the last thing you should think about. Like, even if you were to truly have a loss of that size, I think like there are ways to get help. There are ways to deal with that, unfortunately don't involve, something so drastic like that. I don't know. I don't know what else to say about it other than like, I hope it's a wake up call for the brokers and for people that are trading these markets that don't fully understand them. And I hope that more people will seek out education.
Yeah.
Yeah. It's a double-edged sword with Robinhood because they've become so popular because of the way they've made something more complicated so simple, literally, to where anybody could get the app and start trading options and, understand how to put in an order because of the way that they structure it. But then again, it's getting people into trading a very complicated instrument that they definitely need to be studying and understanding before putting their money into it.
Yeah.
It's one thing to buy shares of a stock and just hold, right? It's another thing to buy options and try to do different strategies with options. It's different.
Yeah. Yeah. People need to realize that when you're trading a derivative market like futures or options or anything that gives you access to margin or leverage or more than just a spot position, right? Where you buy Bitcoin and you own Bitcoin, or you buy Apple and you own Apple, right? Anytime you're speculating on these higher risk leveraged positions, people need to understand that you can lose more than the money that you have in your account. Now, in theory, that shouldn't happen. It should be a very rare thing. But I've gotten so many emails and messages from young guys on these shitty, unregulated crypto exchanges where they're like, hey man, there was a flash crash on BitMEX or one of these other platforms, and literally all my money on this account is gone and I don't know how that happened, right? And that's the danger of trading on anything that's leveraged, trading on unregulated exchanges where a lot of the things that are illegal in the US, like spoofing and, all the stuff that's been basically hammered out of the regulated futures markets, that stuff is thriving in these unregulated markets. So I think there's a few things to think about there, right? And also to Robinhood's point about making it so easy for just, step 1, 2, 3, and then all of a sudden you're trading options. Like, that is a very dangerous thing. And it looks like, this was a letter, I guess, that Robinhood put out a few days ago where they acknowledged, what happened. And they said, they're going to try to make improvements with eligibility, with additional criteria and education, which I think is absolutely important. And then maybe, different improvements to the like you said, Trav, the UI, where maybe they're not going to get some scary number that flashes and makes them think that their life is over.
Yeah.
And, I think this mentality that's going around in Wall Street bets and, what's happening through what David how do you say his name? Portnoy.
Yeah.
All of that, stocks only go up and all these things. I think that it's potentially a dangerous mindset to be. These are beginner investors that are interested in investing and trading, and that is not the mindset that you want to have going into this. If you want to become a professional investor, you're not thinking about risk. You're not thinking about, the downside. You're kind of being told, yeah, YOLO options and stocks only go up. And I just think it's a dangerous mentality for young investors, young beginner investors.
Yeah. I agree. We talk a lot about, getting rich slowly, or, getting rich at a moderate pace. People who are trying to get rich quick, that's usually, whether it's in investing or business or something else, it's usually a recipe for disaster. The most famous investor in the world, Warren Buffett, massively wealthy, top 5 wealthiest men, people in the world. And, he always stresses, like, his rule number 1 is capital preservation. It's all about, like, not permanently losing capital. And yes, like, there are people that have these short-term runs where they grow their capital at some astronomical rate, up 1,000%, up, 10,000%. But, typically then they make some mistake where they take a huge permanent capital loss and they set themselves back. And, what we're trying to do is we're trying to compound. We're trying to use the magic of compounding over time to just consistently, with an eye towards capital preservation, grow our wealth. And so I would just encourage people to think about that as a way to more consistently grow their wealth and not be in a position where you're having to explain to your spouse that you lost your retirement money or you lost half of it. There's too many situations like that, the get rich quick schemes, right? It's just a classic age old story. And right now, like, a lot of that stuff is working, and, fine, but there will come a day when that stops working, and maybe, like, we'll get another March, but it won't bounce back the way it did. So, I think people need to look at what they're doing and look towards like a sustainable strategy.
Yeah. If I could just give one piece of advice to newer investors and traders, it would be, and like, you should like write this on your computer screen or wherever you trade, is goal number one is surviving. Don't do anything that can permanently take you out of the game. Like if you get margin called or get your account wiped out, that's money that you probably worked really hard to get and now is gone. And if you look at a lot of the charts on Wall Street Bets and some of the other places, you'll see guys that make hundreds of thousands or a few million, and then that equity curve comes right back to zero. So the markets will eventually punish you. You could get lucky in the short term, but if you're reckless, you will get wiped out. It's only a matter of time.
Yeah.
It's like if you sit at the craps table and you're like, you keep putting it all on red or black, you could have a string of winners, but eventually it's going to go to zero. So take risk capital and risk preservation and risk management very seriously, and you'll create life-changing wealth over time. It's going to take some time, but what would you rather have, a few $1,000,000 in several years, or continue to struggle and go up and down and be depressed and get wiped out and margin called all the time? Like,
yeah. And you can take some high risk plays. We definitely take high risk plays occasionally, but we know how to properly position size. And, my goal is 20 to 25% compounded annual growth. And in a world of 0% interest rates, if you're growing your purchasing power at 20 to 25% a year, maybe some years less, some years a little more, like, you're going to create massive wealth over time if you're doing that for 10, 20, 30, 40 years.
Yeah.
Be patient, manage risk.
Yeah. And you will have, like, if you are a lifelong investor, if you're somebody who's like, I'm in this for the long term, you can have days, weeks, months, or years where you make outlier profits, right? Like the most amount of money I've ever made was getting into Bitcoin early, right? And that has compounded over the past 7 years, right? It's changed what I thought I was going to have many, many multiples, right? Like an order of magnitude. And like, you could have those events, right? But if you just keep that goal in mind of survival first, and then you participate in some of those that may come along in your career, like, that's going to vastly change the trajectory of where you end up in a decade or two. So I don't know. I think, we've kind of hammered that lesson over the past few weeks, but it's so important because there are just so many reckless investors out there right now. And like, just this soup of weird things that have come together that I just see are causing a lot of people to lose a lot of money. And like, we want to help people not be in that category. So
yeah, and I'll put in a shameless plug here for our community. That's what we're doing with our investing community, is we're focusing on helping people and educating people about investing. And so I think if you're lacking that, I would definitely encourage you to look at something like our community as a way to leverage a resource of people who have been there, done that, who can help and make sure you don't make really, really egregious mistakes along the way.
Mm-hmm.
Yeah, absolutely. All right. Well, let's keep going, guys. Next question is from Erica. Nikki, we'll kick this one over to you. What mutual fund is best to put your money in as a 24-year-old? So there's some assumptions in there.
Yeah. So obviously I have to speak generally about this, but when you're 24, you're young, you have a lot of time until you hit retirement age, unless you're trying to, retire earlier. But basically, something you could do is a mutual fund or an ETF that just tracks the S&P 500 or tracks the NASDAQ, if you want to go more tech heavy on that. But basically, there are mutual funds that will try to buy the same types of stocks that are in the S&P 500, and you're essentially diversified across all sectors, and you own the big players in the market, the Facebooks, the Amazons, the Microsoft, Google. So that's what I think. When you're young, you want to be in the market, you want to have equities, because you have a lot of time to let those equities work for you. So,
and then what do you think of like a low fee index fund versus a mutual fund? Is there a reason to go into a mutual fund nowadays, or is that just kind of a waste of money?
Sometimes, depending on what type of account you're investing in, like if you have a 401k at work, the 401k may only allow you to invest in mutual funds. It depends what the offerings are, meaning what kind of account is it and where is it held. So generally, an ETF that tracks the S&P 500 or something that tracks the NASDAQ would be probably the lowest cost. But I have seen mutual funds offered that are rivaling and trying to match that. They're doing the same thing, passive. They're tracking the index and just same low fees same low expense ratios that you would get with an ETF. But ETFs usually tend to be lower than a mutual fund.
Cool. So it sounds like if your only option is a mutual fund in your 401k, if that's what your employer offers, then go with that. If you're kind of a DIY, like a do-it-yourselfer investor, and you have your own capital or your own retirement account, then go for something like a low-fee index fund.
Yeah, low-fee index fund. An ETF would work great for that.
Yeah. Awesome. All right. Next question. Alex was asking, what about Tezos? Are you still holding this altcoin? Any fundamental changes to alter investment decisions? Yeah, I guess, I can do like a quick overview of the crypto space right now. Right now, if we look at, here's a couple of things I'll say. I'm a big fan of, right now we have the DeFi movement. I'm a big fan in general of exchange tokens. Because exchanges are cash cows, right? That's just one kind of market segment of the crypto space that tends to be nice. They're rent-seeking companies. They get a piece of every transaction, for good or bad. I really like decentralized tokens right now. I also like new innovative networks. Tezos, I think, is one of those. Another coin that we got into recently is Kyber. So you can see here, this was one that we actually bought a couple weeks ago as it was breaking out above the 80 to 90 cent range. And again, this is just another decentralized exchange. I think this is kind of the future of exchanges and where the value is here is you actually have custody over your tokens. So instead of like putting your coins with Bitfinex that can get hacked, you go through and trade through a decentralized exchange, and you still control your private keys and just have more control overall. And so I think this is just a really good space to kind of keep in the back of your mind or do some research on. And that's really it. Right now, I think in late 2020, we're going to see the culling or the death of a lot of these zombie coins that really haven't innovated or done much over the past couple of years, right? There's a lot of stuff from the 2017 bubble that's still around that just really needs to die. But there are some market segments of the crypto space that I'm really excited about. Still really interested in security tokens, which again, that is really more of just like an evolution, not really revolutionary. It's just like the next step of private equity and private investments. We're tokenizing those things like real estate and equity and startups. But yeah, decentralized exchanges, I'm just really bullish on, and also things like Tezos. So let's see here. Let's go to the next question. At Extra Fancy Budgeting asks, what is an annuity? And I know this is something that has been kind of a controversial topic in recent times. And I don't know. I mean, is there even a use case in a zero interest rate environment for these? And, what are they? Who are they right for, if anybody? And what should somebody think about?
There actually can be a use case for an annuity, usually when you're doing retirement planning and trying to, get your income level to a certain area. But yes, they've gotten a bad name because they've been abused by insurance salesmen. They have, they can have high fees. Basically, what an annuity is it's an insurance contract where you're giving the insurance company a certain amount of money, and they're guaranteeing you in the future a certain amount paid to you on a monthly or yearly basis. So usually you buy an annuity contract, to supplement retirement income in the future. And it's more of a just in case type thing. I wouldn't look at an annuity as necessarily an investment product, although you can buy a variable annuity that invests in the market, and you would get, usually a specific return, depending on how the contract is written. They may cap your return. So, you could be investing over here on your own and getting the full return in an index fund, or you can invest in an annuity and basically they're going to take a cut of your returns and pay you whatever your contracted amount is in retirement. So annuities can be tricky. You definitely want to have somebody helping you review the products to make sure that you're not basically getting hosed. Usually some type of CFP or an insurance professional that you trust that can help you navigate the landscape. But yeah, it's basically just a way to guarantee income in the future. And I would look at it more as an insurance product versus an investment product.
Awesome. Trav, any thoughts on that?
No, I think Nikki covered it.
Cool. Next question from Melissa. Do you have any good resources for Backdoor Roth? So maybe we can explain what that is and why somebody would want that.
Yeah, a backdoor Roth conversion is basically, so to contribute to a Roth IRA, which is an IRA where your contributions are taxed going in and then they grow and then you can take them out in retirement tax-free. That type of account, if you make over a certain amount of money, you can't contribute to it at all. You can't go Roth at all. Roth 401ks are different. If you have access to a Roth 401k at work, you don't have any income limitations there, but Roth IRAs you do. So what a lot of people do is they'll do a backdoor Roth to try to get money into that Roth account by taking a traditional IRA and contributing to that. It's not deductible if you make over a certain amount, but you do a non-deductible contribution, or you convert what you have in there already and you convert it to a Roth. So that's what a backdoor Roth is you contribute to a traditional IRA, convert it to Roth. I think that Fidelity and Charles Schwab, a lot of the brokerage accounts have good resources and good article write-ups explaining the Roth conversion, and they can kind of help guide you through that process. So I would say try to go directly to like Fidelity and search their website for Roth conversion information. And they have a lot of stuff on those websites.
Awesome. We've gotten some questions about a recent scandal about Wirecard. So Wirecard, what happened here, Trav? They went, basically they're missing like $2 billion. What happened with this and what are the repercussions?
Pretty classic case of fraud here. And yeah, they faked some cash balances among other things. I think we'll also find out that they overstated profits for a number of years, but yeah, I mean, there were some really, really smart short sellers that came out and tried to uncover this fraud, and a couple of financial journalists as well. There's some, I retweeted actually a really good, thread on some of the players involved, but this was a high flyer company that had a high valuation, a payments-based company. There's a real business here, but they overstated revenues, overstated their cash balances by several $billion. The auditors previously had signed off on all their accounts and said everything was fine, but some short sellers and some investigative journalists did come out with some kind of damning evidence indicating that they thought that this was certainly a fraud, and it turns out it was. One of the interesting things that happened here, and this happens in many classic cases of fraud, like Enron and Theranos and Allied Capital. You actually see a lot of the regulators and people at companies and people in the media, they actually tried to attack the short sellers and the people that were trying to bring the evidence to light. I think Bad Blood, of course, that covers Theranos is a great example of that, where the company and their PR department tried to attack them in every way possible. They tried using even lobbying efforts to try to take down or even get charges pressed against the people that were trying to expose the fraud. How many times does this have to happen in our public markets before people start to actually look at some of these smart short sellers and say, maybe there's something there, maybe we should investigate. And so Wirecard eventually was exposed over the last few weeks and months, and the stock, took a massive hit last week. And I imagine it'll be interesting to see what happens. There's rumors that it will have to file for bankruptcy and restructure. But yeah, if you go to my Twitter profile, I also retweeted, there's I think a couple of tweets down from Donut Shorts. Yeah, he talks about some of the players involved. And, the German regulators actually are at fault with a lot of this. The German regulators overlooked evidence that was given to them directly by financial investigators and took management's word. And unfortunately, the incentives are all wrong with a lot of this stuff. Like, auditors are not incentivized to actually try to uncover fraud at companies. They just get paid by the companies and sign off on their financial statements. So this should be a wake-up call for a lot of global securities regulators, global investors. This was a multi-billion-dollar market cap company found to be fraudulent. So very similar to Enron in a lot of ways, WorldCom, a lot of the big frauds that we've seen exposed over the last 10 or 20 years. So there's more out there, by the way. There are others that are known to be similarly creating some really shady accounting practices and have questionable things happening in the financial accounts, Tesla being one of them. I know that is a favorite stock of many people, and there is a real product there. Obviously, people love the cars, but there's some really questionable accounting, and that's one of the reasons why I've avoided it, because I think you could wake up one day, if anybody ever decides to actually take action, then whether that's the auditors or the government or whoever, I think you could be facing something where you wake up and the stock's down 50 or 60%. Who knows? Maybe it'll never happen. Maybe, it's all overlooked.
I was waiting for you to I was going to be like, Tesla, because I know.
I think it's important. Yeah. I think it's important to put that warning out there for people, if they're asking about, well, who else could be out there committing fraud? There was some interesting write-ups on Alibaba as well in the last few years, especially right after they had IPO'd in the US. There was a lot of questionable accounting, a lot of changes in the disclosures, a lot of strange things happening. And again, you can have a real business underneath. You can have a thriving, growing real business underneath, but sometimes those executives are also incentivized to make things look a lot better than they even are and to enrich themselves in certain ways. So yeah, I mean, Wirecard, just another classic example. There's others out there. I think we should be listening to credible short sellers. Now, there's obviously short sellers out there who are out there to just kind of smear companies, although I don't see that very many of them. But when someone like Jim Chanos, who exposed Enron and a few other frauds, and people like David Einhorn, who exposed Lehman Brothers before their bankruptcy, who exposed Allied Capital and wrote a book about it, when those kind of people stand up and say, hey, regulators need to look at what's going on here, I think we should all pay attention.
So Trav, are there any kind of tall tale signs or like things that investors could look for to avoid these frauds, right? Because if you own a company and then you wake up and, you see an article come out and then the next day the thing's down 90% like Wirecard, like how can you avoid being on the wrong side of this stuff?
Yeah, well, I think one, listening to any credible short sellers and looking through their reports, usually they'll produce detailed reports in many cases that can be 100 or 200 pages long, detailing some of the issues. So that's one. Second of all, there's things you can look for in the financial accounts themselves. And we go over this in some of my investing course. And there's books like Financial Shenanigans, which talk about things like, if they're reporting a lot of revenue growth, but it's never showing up in cash flow, for instance, accounts receivable keeps growing, or strange things are moving between accounts. If there's changing disclosures and changing metrics all the time, that's one of the things that Tesla does, is they're constantly moving the goalposts and trying to get investors to focus on whatever number they want them to focus on that quarter and forget about all the other things that they said before. Those are red flags. Anytime executives go after short sellers or go after the people who are criticizing them, quite frankly, the best way to, if you really are running a great business that's growing, then you don't need to go after short sellers. You just keep executing on the business and your stock price will follow. And we've seen that with companies like Netflix, where there've been a lot of critics of the company. And Reed Hastings even addressed it, I think 5 or 6 years ago. He said, yeah, I understand your criticisms, but here's where we're going with the business model. And the stock has done phenomenally well, and the business has done phenomenally well. But when you see executives attacking the short sellers, using PR firms to try to smear short sellers, then that, I think, is a huge red flag. And we see a couple companies, including Tesla and Nikola, those CEOs of those companies, doing that lately. Memetics was another recent fraud that was exposed by a famous short seller. And in that case, they had used private security firms to try to harass the short sellers that were trying to expose the company. And that's obviously a big red flag. So Memetics is down, I think, now similarly over 50%.
You know the ticker off the top of your head?
I think it is MDXG where it was. And that one was exposed, I believe, in the last 12 months. Mark Cohodes, he's a famous short seller, spent several years trying to expose the fraud at Memetics.
Yeah, it was down 95%. Now it's down around like 75 off of the all-time highs.
Yeah, and they had even tried to SWAT him and all kinds of weird stuff that the company was focusing on rather than their business. So yeah, those are some of the red flags. There are others. Follow people like Jim Chanos, the famous short seller and hedge fund manager. He often talks about, he teaches a class at Yale on financial fraud and has a lot of interesting things to say about that. So
nice. Well, guys, we covered a lot of stuff today. Any other final points or anything you guys want to talk about before we wrap it up?
Nobody asked me about my recent vacation spot.
Yeah, it
no
looks
one
like you're
cares
hanging out in
where
the
I
mountains
am.
somewhere.
I'm in Banff.
It looks
for you guys listening to it, Nikki's got the background on Zoom up from our Banff
Had to get the hell out of here.
it looks magical.
Yeah,
Take me
I'll
there.
tell you, Texas is becoming less and less attractive as these numbers get worse and worse here. So I'm like definitely looking to get the hell out.
Yeah, I can understand that.
Yeah. Cool. All right, guys. Well, thanks for watching. Don't forget to go to wetalkmoney.com to submit your questions for the show. And if you want to check out our investor community at the Skill Incubator, we'll link that up in the show notes as well. And subscribe to the podcast if you want to listen to this on audio, and share it with anybody you think would get value from it. So thanks, guys, for joining us.
Thank you.
See ya.
Thanks, everyone.